The once-in-a-lifetime crash everyone fears, it's not coming, it's already happening, and most people have no idea. Have you ever felt that weird tension in the air, like everything around you looks fine, but something underneath just isn't right? Your 401k looks great, the stock market is glowing green, everyone keeps saying the economy is strong, but then you look at your actual life, your bills, your rent, your groceries, and suddenly it feels like you're living in a completely different economy than the one on TV. And here's the scary part, you're not imagining it. Two major economic signals, ones that have moved together for 30 years, have suddenly ripped apart like they're living in different universes. This kind of divergence doesn't happen quietly. It happens before big resets. In this video, I'm going to show you why your income has quietly fallen behind, why assets like housing have become completely detached from reality, and why this strange split between your world and Wall Street's world is the clearest sign that the reset has already begun. By the time we're done, you'll understand exactly what your gut has been trying to tell you, what's pulling the economy apart, and what you should be watching before things flip fast. Let's begin. Chapter 1. The unsettling disconnect. Are we living a lie? Imagine a bizarre world where everyone agrees the party is raging, but individually they're all quietly panicking. That's precisely the economic paradox we're living through. On one hand, consumer confidence in the stock market is soaring, hitting levels higher than the infamous dot-com bubble of 2000, a period notoriously etched in history for its irrational euphoria. You, the investor, might be seeing your portfolio swell, feeling a fleeting sense of security as the S&P 500 continues its relentless climb. This isn't just a slight uptick, it's a bullish fervor that defies conventional wisdom, painting a picture of robust prosperity for anyone invested in the market. Yet, beneath this veneer of market optimism, an entirely different story unfolds. Simultaneously, the University of Michigan's survey on people's personal economic outlook, a barometer of how ordinary Americans feel about their own financial future, has plummeted to levels last seen at the heart of the great financial crisis. Think about that for a moment. Your 401k statement might look fantastic, yet you, the working professional or small business owner, are feeling more financially vulnerable and depressed about your future than at almost any point in recent history. This isn't just a minor discrepancy, it's the first time in over 30 years that these two lines have diverged so dramatically, creating an unprecedented psychological and economic rift. This isn't just a symptom, it's a glaring crack in the foundation, hinting at problems with extremely deep roots, problems that will eventually demand a profound economic reset to be resolved. Chapter 2. The wealth engine, who wins when everyone else loses? So, how did we get here? How did this chasm between personal struggle and market euphoria become so vast? The answer lies in another critical divergence, one that directly benefits some at the expense of many. Let's look at the average personal savings rate in the United States. Since the 1980s, it has been in a persistent, alarming decline, plummeting from around 13% down to a mere 4% today. Think about that. The average American, the professional trying to build a nest egg, the business owner trying to save for expansion, is saving less than ever before. Now, overlay that with a different trend: corporate profit margins. While the savings of the average American have been steadily eroding, corporate profit margins have been relentlessly climbing. This isn't just a coincidence, it's a fundamental shift in how wealth is generated and distributed. Corporate profits ultimately are largely distributed to shareholders. And here's the crucial difference. Unlike wage earners, who spend most of their income on necessities, shareholders, particularly the wealthy ones, don't spend the bulk of what they receive. Instead, a significant portion gets reinvested directly back into financial assets. The consequences of this dynamic are all around us, manifesting as a dizzying surge in asset prices. Home prices are at record highs, making homeownership an increasingly distant dream for many working families. Gold, that age-old hedge against instability, has been hitting new all-time highs. Even Bitcoin, once a fringe asset, is now trading at unprecedented levels, being adopted as a new financial class. All of this dizzying appreciation of assets, is fueled by a backdrop of record corporate profitability, which in turn feeds a continuous cycle of reinvestment into these very assets. For the investor already holding these assets, it feels like a golden age, but for the aspiring homeowner or the professional trying to break into the market, it's a relentless losing battle against a system that increasingly favors capital over labor. This process, while seemingly a natural extension of the financial system, creates a ticking time bomb when it begins to impact the most fundamental human need: shelter. Chapter 3. The unbearable weight of home, the core of the crisis. For the better part of 6 decades, the dream of homeownership, the bedrock of middle-class wealth, was relatively attainable. The average price of a home hovered around 4 times the yearly household income in the United States. This ratio, while a stretch for some, was a clear, achievable goal for most working professionals and families. It meant that with diligent saving and hard work, owning a piece of the American dream was a realistic aspiration, a tangible marker of upward mobility. But since the late 1990s, that ratio has completely unmoored itself, skyrocketing to roughly 7 times the average yearly household income. This isn't just a slight increase. It effectively makes housing about 2 times less affordable than it was for previous generations. As a working professional or business owner, you know that shelter isn't a luxury. It's the single largest component of the consumer price index, consuming an ever-growing share of your monthly budget. If a disproportionately large chunk of your income is swallowed by rent or mortgage payments, what's left for savings? What's left for investing in those very assets, stocks, gold, Bitcoin, that have been compounding wealth for those who can afford them? In practical terms, this means that for millions of households, the path to building intergenerational wealth through asset ownership has been effectively blocked. Their expenses rise, their income stagnates, and their ability to get ahead, to move beyond where they started, remains tragically out of reach. We see the devastating impact of this on the collective psyche. Back in 2000, roughly 75% of Americans believed they had a good chance of improving their standard of living. By 2010, that optimism had plummeted to 50%. Today, a staggering 25%. That's a precipitous drop in just 25 years, reflecting a profound sense of despair and economic stagnation. This profound shift has translated into an alarming statistic: the highest level of wealth inequality in the U.S. since the Roaring '20s. The share of wealth owned by the top 0.1% of the U.S. population now stands as a stark testament to a system that is no longer working for the majority. Final question: the inevitable reckoning. What comes next? So, what does all of this mean for you, the investor, the business owner, the working professional, navigating today's treacherous economic waters? We stand at a precipice, mirroring a historical moment almost a century ago. The consensus among many economists and analysts is that this great reset will come when the line representing corporate tax rates finally reverses course and starts moving higher again. This will almost certainly cause immense pain across the financial landscape. It will squeeze corporate profits, potentially dragging asset prices down violently, much like they did in the 1930s. The stock market, ever the forward-looking beast, discounts future events. This means it's entirely possible that the market could peak before corporate taxes actually begin to rise, anticipating the coming shift. We saw this in 1929. The market peaked a year or two before corporate taxes were formally raised starting in 1931. For now, the dominant narrative remains one of financial market strength. Many investors, including our team at Bravos Research, are currently positioned long on assets that continue to benefit from today's macroeconomic backdrop. That includes stocks, gold, and crypto. These are the assets experiencing extreme inflows as money continues to flood into financial markets, driven by the very dynamics we've discussed. But make no mistake, there will come a moment when this trend flips in the opposite direction. The signs are mounting, the historical precedents are glaring, and the economic divergence is simply unsustainable. That's when things could get ugly. When that flip occurs, the strategic posture for protecting and growing your wealth will need to shift dramatically, from an offensive growth mindset to a much more defensive one. Understanding when that pivot will happen and how to position yourself for it will be the difference between those who weather the storm and those who are swept away. The era of easy gains, fueled by an artificial divergence, is drawing to a close. The economic reset is coming, and your preparation starts now. If you're an investor, a business owner, or a professional determined to thrive through this unprecedented shift, understanding these dynamics is paramount. The future of wealth is being redefined. Make sure you're on the right side of history.